Banking and financial regulations play a critical role in ensuring the stability and integrity of the financial system. These regulations are put in place by government agencies and are designed to protect consumers, promote competition, and maintain the stability of the financial system. In this blog post, we will cover the basics of banking and financial regulations and how they impact the financial industry. One of the main goals of banking and financial regulations is to protect consumers. This is done through a variety of measures, such as setting minimum capital requirements for banks, implementing consumer protection laws, and establishing deposit insurance. These measures help to ensure that consumers' savings and investments are protected in the event of a bank failure. Another important aspect of banking and financial regulations is to promote competition in the financial industry. This is done through measures such as limiting the concentration of assets in the hands of a few large banks, encouraging the entry of new competitors, and preventing anti-competitive practices. These measures help to ensure that consumers have access to a wide range of financial products and services at competitive prices. In addition to protecting consumers and promoting competition, banking and financial regulations also play a critical role in maintaining the stability of the financial system. This is done through measures such as implementing prudential regulations, which set minimum standards for risk management and governance, and through the use of supervisory tools such as on-site inspections and off-site surveillance. These measures help to ensure that financial institutions are operating in a safe and sound manner and that the financial system as a whole is able to withstand shocks and crises. One of the most important regulators of the banking and financial industry is the Federal Reserve. The Fed, as it is commonly known, is responsible for implementing monetary policy and regulating banks and other financial institutions. The Fed has a number of tools at its disposal, including setting interest rates, issuing regulations, and providing liquidity to the financial system. Another important regulator of the banking and financial industry is the Securities and Exchange Commission, SEC. The SEC is responsible for regulating securities markets, including the stock and bond markets, and protecting investors from fraud and other abuses. The SEC also oversees the activities of securities brokers, dealers, and investment advisors. In conclusion, banking and financial regulations play a critical role in ensuring the stability and integrity of the financial system. These regulations help to protect consumers, promote competition, and maintain the stability of the financial system. Understanding the basics of banking and financial regulations is essential for anyone involved in the financial industry or for anyone interested in investing in the financial markets. In addition to the Federal Reserve and the SEC, there are several other important regulators of the banking and financial industry. The Office of the Comptroller of the Currency, OCC, is a federal agency that charters, regulates, and supervises national banks and federal savings associations. The OCC also issues regulations and guidance to these institutions to ensure they operate in a safe and sound manner. The Federal Deposit Insurance Corporation, FDIC, is an independent agency that insures deposits in banks and savings associations. This deposit insurance helps to protect consumer savings in the event of a bank failure. The FDIC also supervises and regulates state-chartered banks that are not members of the Federal Reserve System. The Consumer Financial Protection Bureau, CFPB, is a federal agency that was created to protect consumers from predatory lending practices and other financial abuses. The CFPB has the authority to issue regulations and enforce consumer protection laws. The Financial Stability Oversight Council, FSOC, is a federal body that was created to promote financial stability by identifying and addressing systemic risks in the financial system. The FSOC is made up of representatives from various federal agencies, including the Federal Reserve, the SEC, and the FDIC. Finally, it's worth mentioning that these regulations are not only limited to U.S., in fact, Most countries have their own set of regulations for banking and financial industry. Many of the international organizations such as Basel Committee on Banking Supervision, Financial Stability Board and International Organization of Securities Commissions provide guidance and recommendations for countries to follow and strengthen their regulations. In summary, banking and financial regulations are put in place by government agencies to protect consumers, promote competition, and maintain the stability of the financial system. They are implemented and enforced by a variety of agencies, including the Federal Reserve, the SEC, the OCC, the FDIC, the CFPB, and the FSOC, as well as international organizations. The regulations are constantly evolving to adapt to the changing financial market and to tackle new risks. It is important for the financial institutions and individuals to keep themselves updated with the latest regulations to ensure compliance and avoid penalties. Another key aspect of banking and financial regulations is the oversight of financial markets. Regulators such as the SEC, the Commodity Futures Trading Commission, CFTC, and the Financial Industry Regulatory Authority, FINRA, are responsible for overseeing different segments of the financial markets. The SEC, for example, oversees securities markets, including the stock and bond markets, and enforces securities laws to protect investors from fraud and other abuses. The CFTC, on the other hand, is responsible for regulating commodity futures and options markets, including the derivatives markets. FINRA is a self-regulatory organization that oversees brokerage firms and their registered representatives, ensuring that they are complying with federal securities laws and regulations. Another important aspect of banking and financial regulations is the oversight of financial institutions. Regulators such as the Federal Reserve, the OCC, and the FDIC are responsible for supervising and regulating banks and other financial institutions. They issue regulations and guidance to these institutions to ensure they operate in a safe and sound manner and have adequate risk management in place. Banking and financial regulations also focus on the prevention of money laundering and financing of terrorism. Regulators such as the Financial Crimes Enforcement Network, FinCEN, and the Office of Foreign Assets Control, OFAC, are responsible for enforcing anti-money laundering, AML, and countering the financing of terrorism, CFT, regulations. Financial institutions are required to implement robust AML/CFT programs and comply with reporting requirements to help detect and prevent illicit financial activities. Finally, it's worth noting that recent years have seen an increase in regulations related to the environment and social governance, ESG, issues. Institutions are expected to disclose information related to the environmental and social impact of their activities, assess and manage risks related to climate change, labor rights, human rights, and other ESG issues. In conclusion, banking and financial regulations are complex and multifaceted. They cover a wide range of areas, including consumer protection, competition, financial stability, financial markets, financial institutions, money laundering, and ESG issues. They are implemented and enforced by a variety of government agencies and self-regulatory organizations. It is important for financial institutions and individuals to stay informed about the latest regulations and comply with them to avoid penalties and ensure the integrity of the financial system.